Good afternoon. So I know many of you in the room. My name is Chris Kavanaugh, as Cindy said. I work for Vanguard. I'm responsible for all our RIA relationships throughout Ohio, and I live in Columbus. So, OH. So I am very happy and appreciative that Vanguard was willing to send out our senior investment strategist, Andrew Patterson, today. So Andrew has been with Vanguard for 13 years. He has worked in what we refer to as our investment strategy group for the last 7 years, and he heads up our economic strategy team. And as many of you know, we write once a year an annual economic and market forecast paper, which is sitting on your chairs. And Andrew is a co-author, and his team put that paper together. So I wanted to give a warm welcome to Andrew Patterson, who's going to go through that in a slide format. And if any of you are interested, we can certainly provide these slides after the event today. So without any further ado, Andrew Patterson.
Thank you, Chris. And thank you all for the opportunity to come out to Cleveland today. I was a little hesitant coming out in February. I heard a lot of horror stories about these lake effects, but I'm actually thinking about purchasing a home on a lake when I go back home now. So it's been a great trip. Met a lot of great people out here. Really like the city. I spent my first night downtown last night, so it's been great. But in terms of the economic outlook, the way I usually like to run these is I try to keep it as conversational as possible. And my wife always tells me I tend to drone on, so I try to avoid that and try to engage the audience as much as possible. So if you have any questions about anything that I'm covering, whether it's on the slide or not, just please let me know, because my time is best served helping you address what might be front of mind for you or your clients. So in terms of the economic outlook, as Chris mentioned, I'm one of the co-authors on Vanguard's Economic Investment Outlook. It's our flagship publication. It's published each December, and I'm one of the co-authors, but there's about 5 or 6 of us. That really doesn't do it justice. This really represents the best thinking of the entire investment strategy group at Vanguard, which is about 50 of us worldwide. We have offices in Philadelphia, Pennsylvania, where I'm based out of, Scottsdale, Arizona, the United Kingdom in London, Melbourne, Australia, and also Hong Kong, and a smaller office in Tokyo as well. So it really is a global organization and a global effort to put this together. So 2 things that sort of set us apart in the industry, or at least did when we first started doing this about 5 years ago, was the long-term nature of our forecasts. You're not going to see point forecasts over the next 12, 18 months. You're going to see longer-term forecasts, particularly when we're talking about asset class returns. The other being the distributional nature of our forecasts. So forecasting can be a very, very humbling exercise. So we like to treat the future with the deference it deserves. So anytime you see any sort of prognostication on our part, it's going to be presented in a probabilistic framework. So you'll see the use of histograms, box and whisker charts, what have you, in various slides, just to show investors that, yes, we may have a central tendency or even a median point in our projections, but that's not the only part of our projections. Also the potential for error, the potential for missing high and low around that, because we want investors to have the most information possible to make as sound a decision as possible when they're deciding on their asset allocations and investment spending decisions. So in terms of the themes and outlook, this is really our summary of that, so I'll spend about 15 minutes going through this and then see, again, if you have any questions, please feel free to stop me, or else I'm happy to walk through the slides and see how we progress. But in terms of our themes and outlook for 2016, much like 2015, our views on growth, actually our views on the global economy in general, we term that frustratingly fragile. So what do we mean by frustratingly fragile? Well, developed markets in particular are on a bit surer footing than it has in the past. Sure footing it's really a relative term. Growth here in the U.S., we're not going back to that 3.5–4% growth we enjoyed during the 1980s and 1990s. Rather, a longer-term trend estimates somewhere closer to 2%. And our view is that over the next 12 to 18 months, we're likely to slow to that 2%. We actually hit that last year in 2015. So we expect that to continue, whereas others may be forecasting more of a cyclical bump, somewhere closer to 3%, which is where we were at last year. We think the time for that is past. In Europe as well, I mentioned a bit surer footing. That's certainly a relative statement for Europe. So growth there somewhere around 1.5%, whereas it had been progressing rather slowly at about 1%, but a little bit of a bump from the the periphery nations may help add to growth this year. That said, it's an economic environment that is not without its risks. Okay? We've been talking quite a bit about China, talking quite a bit about oil. Those are the types of concerns that have the potential to derail this fragile growth. Okay? Not saying that they are fundamentally impacting growth, because they shouldn't be. At the end of the day, I struggle to find the connection between falling oil prices and falling equity prices here in the U.S. I just don't see how that adds up. Outside of the mining industry, that should be a boon for most other industries here in the U.S. It just doesn't add up. That would be, you would see headlines in the Wall Street Journal and other publications stating that the drop in oil prices is dragging down stock prices as well. If it were falling because there was a lack of demand, that's one thing. But that's not what we're seeing. We're seeing this as a glut of supply in the current environment. So the idea that that's what's driving stock prices lower, we just don't see it. Likewise with China. China's growth likely to slow to around 5% over the next 5 years or so. Okay? That's not a hard landing. We don't see a recession in China's future. That's not our base case. Again, not out of the realm of possibility, but not our base case. Okay? Everyone questions the data coming out of China. We believe it's admirable of them to have admitted that they did miss their growth target for the first time in more than a decade. Back in 2015, they came in at 6.9%, whereas the target was 7%. So we think it was great that they actually owned up to come in a little bit under target. That said, our internal numbers point to somewhat slower growth, again, although not a hard landing type growth. Growth somewhere in the high 5s, low 6s. And again, this was very much as expected for a long time. If markets are forward-looking, they should have been expecting to slow down in Chinese growth as they transition to a more developed market-type model of economic growth going forward, moving away from investment-driven and export-driven growth to a more consumer-driven economy, which has happened with some of their trading partners in the past, and they too have slowed. So this was very much as expected. So again, we struggle to find the connection between China and low stock prices here in the U.S. In fact, fundamentals in the U.S. are rather sound, particularly when you're talking about the labor market. We saw 300,000 jobs created in December. We believe that was a bit of an aberration. We don't think that even the 220,000 plus average jobs created per month over the last 6 months is going to continue going forward. Okay? In all likelihood, job growth is going to slow here in the U.S., and we think it's very important that the Fed communicate this clearly. It's very, very important that the Fed get out ahead of this so that we do start seeing those job numbers that come in maybe around 125, 150,000 a month. The market and market participants are not shocked by that. Okay? It's more of a return to trend, a return to a new trend rather, where you have lower labor force participation, okay? Lower growth in labor force. Not saying that's a good or bad thing. It just, for lack of a better term, it is what it is. Right? And employment jobs reports can't keep coming in so far above that trend unless you start having significant inflationary pressures. So our view is that the job growth will start to slow back down towards trend, as will growth in general, okay? Driven in part by that lower labor force participation, that lower growth in the labor force. Again, I mentioned before, going over the days of 3.5%, 4% GDP growth here in the U.S., much likely to be closer to 2 going forward. And that, in fact, is our view for the next 12 to 18 months. So, some concerning factors, but it really is a new environment, a new economic environment, a new financial environment. So I think that's something that investors need to be aware of and become accustomed to. In terms of inflation, our views on inflation remain guarded actually to the downside. We've been very vocal all along that the idea of a high inflationary environment, despite the extraordinarily easy monetary policy we're seeing come out of the U.S., and now the ECB is joining in, the Bank of Japan, we don't think that those actions are going to lead to high inflation. Yes, they should be inflationary because they're trying to fight deflation. Okay? Here in the U.S., deflation is a little bit less of a risk now, whereas in Europe and Japan it is still very much a risk. Whereas they're expanding their monetary policies, the U.S., I struggle to use the word tightening because that invokes fears of them slamming the brakes on the economy. We tend to view this current cycle of quote-unquote tightening policy is more of a dovish tightening. Right? So what do we mean by that? In essence, we would view the Fed as taking steps to remove existing extraordinarily easy monetary policy. Okay? Fed governors, Fed policymakers have been very vocal about this, that conditions in the United States, from a monetary standpoint, remain extraordinarily accommodative, despite the 25 basis point increase in rates in December. Okay, 25 basis point increase in rates, that's bordering on marginal impact, sort of just attention grabbing for where it was. It was a signaling device. 25 basis points should not and would not be the cause of market volatility or of a slowdown in growth. Okay, these were things that were a long time coming. These are structural in nature. In terms of monetary policies diverging, likely to have implications for the dollar. Okay? Where do we see the dollar heading? We've got a lot of questions from clients around that. The 24+% appreciation of the dollar, depending on the currency you're looking at, depending on the basket, we think that's behind us. Okay? Despite the fact monetary policy will continue to diverge, where the Fed is gradually removing their easing, while the ECB and Bank of Japan are stepping up their easing, we believe that for the most part, that impact has already been incorporated into the valuations of the dollar. So we don't foresee any sort of sharp rise in the dollar going forward for investors that might be concerned with that. In terms of China, I mentioned before that China, in all likelihood, is going to continue to slow. They're transitioning to a more consumer-driven, more service-oriented economy. A lot of the negative sentiment in China is around the manufacturing sector. That's part of their plan, is to move away from the manufacturing sector to become a more consumer-driven, a more service-driven economy. And as they do that, they're likely to continue to slow. So again, we caution against reactionary tactics in such an environment. In terms of Japan, Abenomics, not likely to reach their goal. They've admitted as such. They've made some missteps along the way. They had some fiscal stimulus, and then they went ahead and increased their value-added tax. Okay? Increasing your value-added tax, in all likelihood, is going to depress growth, which it ended up doing, and they have since pushed out the next increase in the value-added tax sometime to at least 2017 and possibly beyond. And the Bank of Japan, even today, this morning, the governor of the Bank of Japan announced that they're going to use all tools at their disposal to combat this deflationary spiral they've been locked in for the better part of the last decade and a half. We believe they have a reasonable chance of achieving their goals, although they do have a long way to go. So expect continued monetary easing in Japan, continued expansion of their policies. So I know we've covered a lot on the economic front. Before I dive into asset classes, did anybody have any questions about that?
Yeah,
sure.
So most of the economic outlooks are pretty positive, but obviously asset prices, equities, credit spreads, commodities, seem to be pricing it a more negative environment. What do you think is?
So, and I have been having a lot of conversations around this recently, and for lack of a better explanation, it seems to be fear. Okay? I mentioned the expectation that China would slow, oil being much more supply-driven issues. So it should be actually a positive for domestic markets. It seems like these negative reactions, whether you're talking about the S&P down 6.5% in January or credit spreads widening a bit, it seems to be more fear-induced. And that is a very, very difficult thing to counter, because fear has a way of perpetuating itself and becoming a self-fulfilling prophecy. We don't think we're at that point yet, but it is something that we'll keep an eye on. If you start to continue to see these declines in the market that have diverged from fundamentals, that's when it starts to be concerning. That's when it starts building on itself, and it's hard to stop that snowball effect. Sure.
Every year it seems to be a political relationship happens.
Sure.
Seems to be Donald Trump stuck that way, but is there anything we see on the outlook for the Congress and the President coming up with 2016?
So luckily we don't have any fiscal cliffs on the horizon, no potential government shutdowns, at least for the next year or so. And I've been asked quite a bit about whether the outcome of an election has implications for the market and economic growth. And we've looked into this quite extensively, and it just doesn't. It doesn't. There may be some short-term volatility, but at the end of the day, it doesn't matter who's in office. It doesn't matter who's in holding the executive office. It doesn't matter who's controlling the Senate or the House. What does matter, though, is that brinksmanship that you mentioned. That's what tends to have significant negative implications for growth and for financial markets. So long as we can avoid that by any means necessary, we should be in a better position than we have been in terms of political implications on financial markets and economies in the past.
Do you have any concerns with oil prices that there could be some structural damage if oil were to move lower? Let's say it went to the $15 or $20 level. The Saudis seem like they want to continue production. They'd love to drive a lot of people out who need $50, $60 oil to be profitable. So I mean, what if you stress test your model? Like, what are your thoughts here if we did see oil continue to decline here? What that would do in the high yield market and some of the other areas there? Because you mentioned demand, and you said it sounds like obviously demand is not great in China, but.
No. So in terms of our views on oil, I mentioned before, it's mainly supply driven. So what we've done here on the right-hand side is decompose the drop in oil prices in 2014 and also 2015, compare that with those in 2008. So clearly 2008, in the grips of the global financial crisis, that was the demand-driven decline. Okay? Whereas you look at the summer of 2014 and August of 2015 to the end of January, the decline is much more driven in blue by the supply side. It's much more an issue of a supply. While the impact of demand has actually increased in the most recent drop, it's still dwarfed by the implications for supply. And you can also see, as I mentioned before, the impact of the dollar is actually lessened, because in the summer of 2014, that's when you started to really see the appreciation of the dollar. That's when it started having negative implications for growth and for oil. That's since abated somewhat. So going forward, you mentioned those countries that depend on $50+ a barrel of oil. I remember reading a piece back in 2007, 2008 maybe, where OPEC or the Saudis had come out and said that they were going to do everything within their power to sustain oil at $25 to $50 because that was the appropriate level. So a lot of the countries, the Middle East in particular, depend on oil to the degree that they do, are able to extract it at $25 to $50, or else they wouldn't have been following that type of economic model in the past. So the idea that they'd be squeezing out any of these nations that are so heavily dependent upon it, I don't see that being the case. What they're doing is they're pushing out those marginal producers in the, let's use fracking for instance, where it costs more. It costs $70 or more a barrel to extract that. So yes, you're going to see some issues in those types of markets where they depend on oil, whether it's North Dakota, the mining industry, Alberta, and Canada. But in terms of an aggregate issue, we don't see that being the case. And the fact remains that while all of this is going on, technology continues to advance. So at some point, fracking may cost less than $50 a barrel to extract. So it's a continuing, quote-unquote, arms race in the oil technology evolution. And I think longer term, lower oil prices, at least for developed markets and those economies that import oil, should be a positive thing. Okay? Not saying that technology is caught up to $30 a barrel, or at least all of the different types of technologies, but we're on our way there. I think it's a long-term positive for growth, and should be for financial markets as well, reducing costs. Sure.
I have a couple of questions about negative interest rates.
Sure.
Apparently, I've read Janet Yellen has said now they're on the table to be considered. What fiduciary would buy a negative interest rate? Has Vanguard bought any negative interest rate bonds? And probably a third question: what's kept pension funds and retirees from picketing the Fed, saying they're contributing to damaging and destroying their pension funds?
In damaging in what way? In the low rates?
Low rates.
Well, I would say that savers have been the sacrificial lambs in this environment for quite some time, since the Fed approached the zero lower bound. So it is frustrating. It's frustrating for a lot of individuals. Fortunately, it hasn't come to the point where there may be some picketing in the streets, but it hasn't been overblown. In terms of negative interest rates, the Fed is looking at all tools at their disposal. All central bankers are talking about the ability to use whatever's on the table. This is a type of forward guidance. They want to make sure that the markets are cognizant of the idea that they stand ready to do whatever it takes. Mario Draghi talked about the idea of doing whatever it took to combat deflation in the Eurozone. Just that statement alone, without any action, back in August of 2012, was enough to drive rates in Spain and other periphery nations down 100 basis points or more over the next several months. Okay? So they realized just how important this type of forward guidance is. I mentioned before the idea of negative interest rates. It's more of a headline grabber. Okay? First of all, in Japan, it's not all negative interest rates. Okay? They're not going to be charging you interest on the reserves that you kept to date. They'd be charging you interest on reserves that you kept going forward. Okay? So adding to your reserves held at the central bank. And you're not forced to hold money overnight at the central bank. Okay? It's more of a signaling device saying, don't hold your money here. Either hold it at the bank or lend it out. That's what they're trying to achieve with these negative interest rates. I don't know that the Fed would need to approach that in the current environment. Again, I personally think they would attempt additional quantitative easing before they go into negative interest rates, before they try that, but it remains to be seen. I just don't see the approach of negative interest rates as having as much impact as when we started the whole global financial crisis. The Federal Reserve was at 525 basis points for a policy rate, dropped that down over the course of 2 years to 0%. That has a much bigger implication for monetary policy, for inflationary pressures, and hopefully economic growth than would going from 0.1% to negative 0.1% as they did in Japan.
So has Vanguard bought any negative interest rate bonds in Europe?
So I don't know that you would buy a negative interest rate bond, so we do have, again, I'm not a portfolio manager myself, but I'm certain that they bought some of those bonds that would have low or negative interest rates. But it wouldn't be that they're extracting a payment from Vanguard, it just impacts the pricing of the bond. You're paying a premium for a bond that would have had a very low yield or even zero yield. So in terms of a negative yielding bond, I don't know that those are incorporated into our portfolios, but I'd have to ask the PMs about that.
I just had a question on you. I'm hoping you're right about your benign on the recession side. But given that, could we have something that a scenario that we've had in the past in the 80s? I think we had it in Texas due to energy. California in the 90s, regional recessions. Like maybe we avoid recession in the U.S. by the technical definition, but end up having regional recessions based on exposure to weaker areas.
I think we're in the midst of it. I think very much the manufacturing sector and those regions of the economy that depend heavily on it are in the midst of a recession. Those regions of the economy, again, I mentioned before, North Dakota, the other fracking regions, they're in the midst of a recession. Okay? Very, very difficult times for individuals in those areas. Again, although the unemployment rate is around 5%, it's significantly higher than that in those areas that depend on manufacturing, that depend on fracking and oil extraction. So I think we're right in the midst of a manufacturing and oil recession. All right. So after the doom and gloom of the economic outlook, what about asset classes? What about our asset class returns? So in our view, again, I mentioned before, we take a long-term approach in forecasting asset class returns. So you can see down along the bottom, balanced portfolios. We think this is one of the most important conversations to have with clients in the current environment. Okay? Gone are the days of a 60% equity, 40% bond portfolio providing you consistently with 8, 9, 10% returns. Okay? We're not going back to that environment for the foreseeable future. Okay? Number one reason, fixed income, yields as low as they are, the math just does not add up. Okay? Bond returns are very, very mathematical in nature. Yields tend to provide a good indicator of where bond returns are headed. The 10-year closed yesterday, I believe, at around 1.8%. Okay? Very, very low. I think that's a 2-year low now. Very, very low relative to history, so we're not going back to the 80s and 90s of 5, 6, 7, 8% returns in your fixed income portfolio. Likewise, equity risks. Our views on equity, we tend to view them as more guarded. Don't like to consider them really bearish. So what do we mean by that? Well, if you consider fixed income and where it is, okay, we believe there's an equity risk premium that you're compensated for taking on additional risk over periods of time. But if your fixed income yield is only 1.8 to 2.25%, your equity return doesn't have to be that high to get a reasonable equity return premium. Okay, that might be one of the reasons, equity risk premium rather, that might be one of the reasons why PEs are so high in the current environment, or are considered somewhat high. So going forward, our expectation for equity returns somewhere in the 6 to 8% range, okay? Not out of the realm of historic norm, but certainly not high by any means. Historically, you'd see equity returns somewhere in the 9 to 11% range. We're thinking more 6 to 8% going forward. So it's a difficult story to tell clients, but again, one that we feel very important because they need to be making investing, working, saving, spending decisions with as much information as possible. That's why I think this is a very, very important chart. So what we show here are the returns of different balanced portfolios over time, and then also our projections going forward. On the left-hand side, the lines rather represent a 20/80 fixed income equity portfolio, a 60/40 portfolio, and then the 80/20 portfolio. So getting progressively riskier as you go on, progressively more aggressive. You can see that over time, ebbs and flows. But then our projections are on the right-hand side. Box and whisker plot, remember the distribution nature of our forecast. This represents the output of our capital markets model. Capital markets model provides 10,000 different potential scenarios. Okay, so any potential scenario you're thinking about, whether it's a bear flattening, whether it's a bull steepening, what have you, in the fixed income market, low equity returns, high equity returns, that's capturing those 10,000 different scenarios. And then we aggregate the results and present them in this framework. So a lot of people tend to focus on the center line there, the median, which clearly is somewhat lower than history. Okay, history being indicated by the orange dot. That's the average since 1926. Okay? So investors that think that they're going back to the types of returns they've enjoyed over the last 80 years or so, over the last 30 years, in all probability, it's going to be very, very difficult to achieve those types of returns. Okay? Investors whose recent memory is a little bit clearer than the longer term memory, since 2000 to 2015, maybe a little bit easier to hit that. Okay? But again, not going back to those 6, 7, 8, 9% balanced portfolio returns that they may have enjoyed over the better part of the last 30 years. So making sure that we're very upfront and clear about that with clients. One of the other questions we get about this a lot is, well, what does this mean about the inflationary environment? Okay, our views on inflation in the U.S. tend to be more muted. Okay? We also don't believe that we're going back to the 3.5%, 4% inflation that we experienced back in the 80s and 90s, such that real returns in a similar chart actually look somewhat more attractive. Okay? Probabilities of achieving returns since the 1926 long-term average, still not that great, but not as bad as they were in the nominal space. Okay, so a lot of factors working to impact our guarded view, whether it's inflation, relatively low inflation, whether it's relatively low interest rates, and the ensuing relatively low equity returns that we're seeing as a result of those.
What's the time period for projection, and is that a U.S. only portfolio, or is that global?
So the time period is over the next 10 years, and in terms of the portfolio, it's 60% U.S. equities, 40% international equities, and then 70% U.S. bonds, 30% international bonds. So it's a global portfolio.
Have you done that for just the U.S., the projections for just U.S.?
Yes. Yes. And it's slightly muted relative to the global portfolio, which again is one of our key tenets for diversification. But if you look here, views on the U.S. somewhat muted relative to global equities including developed and emerging markets. Again, though, those aren't without risks. Okay? We talk a lot about valuations, we talk about where valuations are relative to other asset classes. You can see on the left-hand side, these are where valuations are today for the U.S., developed markets, and emerging markets. And you can see developed markets and emerging markets trading at a discount, particularly on the emerging market side. We would struggle to call emerging markets cheap in the current environment. And we believe there's a lot of risks, a lot of questions to be answered in emerging markets, much more so than developed markets, particularly much more so than the U.S., so that this type of dislocation, this type of divergence may be somewhat justified. So we would caution investors against an overlay, particularly for the emerging market space. The other point that I'll bring up again, keeping these valuations in mind, I mentioned before, the idea of valuations being impacted by interest rates and inflation. Okay? What we show here in the light blue line is the Shiller cyclically adjusted price to earnings ratio, the CAPE. Robert Shiller, it's work he's done, so he's looked at average earnings over the last 10 years relative to price today. And that tends to be a good indicator of returns over time, particularly over longer periods of time. Okay? What we've done is we've actually incorporated into that model the current state of the interest rates, the interest rate environment, and also inflation and inflation expectations. And what we've come up with is what we've termed the fair value CAPE. Okay? What should valuations be? So everyone looks at valuations and say, oh, well the S&P 500 is at 20 and its historical average is 16, so stocks are overvalued. Right, but conditions economically and financially haven't been the same throughout that time period of history that you're defining the average over. Okay, so we think it's important to look at the contemporaneous, the current state. So with the green line, we've incorporated interest rates and inflation into that CAPE and created more of a fair value. And you can see, based on current state of interest rates and inflation, we're actually right around what could be termed fair value from a U.S. equity standpoint. So those investors that may be wary of an allocation to the U.S. because they feel that there's an overvaluation in the current state, we're not necessarily on the same page. We're not necessarily on the same page. We believe that equities here in the U.S. are actually pretty reasonable in the current state, given low interest rates and given our expectation for low inflation going forward. Any other questions about asset class returns? Anything else we've covered? Sure.
A little about the dollar. You said you expect it to slightly or stay at stable levels, I guess.
Sure.
So I saw today, for example, market some activity where actually the dollar was down quite dramatically, and the markets were also down. You thought some correlation in markets and dollar and FX.
So U.S. markets down, dollar down. So again, the dollar appreciating would be a negative for the manufacturing sector. Manufacturing sector, it's not the entire U.S. economy. It's not the entire U.S. financial markets. Manufacturing, I think, is 8–10% of the S&P 500. So the idea that they would move in tandem, whether up or down, I think is a bit of a search for a fit. Correlation doesn't necessarily imply causality. So I would struggle to say that just because the dollar is depreciating, you'd see a decline in financial markets. I think both could be induced by fear. I think if you have investors that are fearful of the U.S. economic situation, which we don't necessarily believe is justified, they could be fleeing U.S. assets. So you'd see a depreciation of the dollar, you'd see a depreciation in those assets as well at the same time. Sure.
Since the central banks are so hyper-focused on getting inflation up, and all of the QEs haven't worked, do you think the next step is just sending people money?
So like the old dropping money from a helicopter, a la the Joker and Batman sort of approach. I don't think they're going to go that far, and I don't know that I would go so far as to say QE has not worked. So Ben Bernanke famously said back in 2007, 2008, and Mario Draghi echoed these comments before implementing quantitative easing at the ECB, that monetary policy has limits. Okay? The goals of monetary policy are not to sustain or drive growth. And you're looking to, at least in the U.S., from the Fed standpoint, maintain full employment in an environment of reasonable inflation. Right? And then the ECB, they're just looking straight at inflation. Okay? So they're not even tasked with driving growth. Okay? If they were to help growth along the way, it's sort of more of a happy coincidence if they're able to do that. But they do have tools at their disposal that should technically help drive growth, lowering interest rates, what have you. But at the end of the day, they need help. They can't carry this load on their own. They need the help from fiscal policymakers, which they had to some degree in the U.S. initially, but then that sort of waned over time. And then that's when they started really calling out the Fed for not helping to drive growth. But at the end of the day, it's fiscal policymakers as well. Okay, so to say that you can depend solely on monetary policy to help drive growth, to drive you out of a recession, I don't necessarily see that as the case. I think it's a combination of both types of policy working in tandem which was the case for a period of time in the US, which is not the case in Europe right now, and which is also not the case in Japan right now. So that's why I think those policies are being looked at as quote-unquote failures.
On your point that politics doesn't seem to have an impact on the economy as such, but as you look at the history of the 60s, 70s, 80s, and indeed even the 90s, when you have tax cuts or tax increases, especially with tax cuts, it raises deficits and immediately results in a sharp rise in interest rates. Isn't that, if we should have any kind of policy like that, don't you think that would have that kind of effect?
So if you implement tax cuts, driving deficits higher, right? So the idea behind driving deficits higher is to help stoke growth, right? So interest rates don't necessarily respond immediately, right? You can run a deficit as a country. You can run a deficit and not increase your debt. We're doing that right now. Okay, debt to GDP in the United States is at 75% of GDP. It's expected to stay that way through 2025. Okay, so and we are running deficits. They're smaller. They're somewhere around 3% now, whereas they have been 10% during the global financial crisis. Okay, and we also what happened during the global financial crisis, where interest rates they're continuing to fall. 10-year Treasury is at 1.8%, despite 40% higher debt than we had going into the global financial crisis. Debt to GDP in the U.S. was about 30%. Now it stands at about 75%. Debt to GDP in Japan stands north of 200%, and their 10-year sovereign debt, I believe, was at 0.07%. Last I checked it. So the idea that deficits and higher debt have to beget higher interest rates, yes, that would certainly be the case, but more so for economies that don't have the ability to I hate using the word print your own money, but at the end of the day, that's what happens with these economies that have floating currencies, that have their own monetary policy. The issues that happened in Greece, where you started seeing debt and deficits lead to higher interest rates and so on, and you have to take out more debt to pay off those higher interest rates. Greece did not have its own independent monetary policy. Okay? Greece was part of the euro, so they were at the mercy of European policymakers who took it upon themselves to make sure that they paid for their sins and were implementing these types of policies, whereas economies like the US, like Japan, are able to implement, whether it's fiscal stimulus, whether it's monetary stimulus, to try to get out of these low growth situations. Greece itself started out with, I think when the crisis started, they had 70% debt to GDP, implemented all these austerity policies, and implemented these measures that had to be taken at some point, but the timing of which seemed a bit premature. They're actually at 125% debt to GDP now, and in a much worse position than they were going into the global financial crisis. So to be concerned simply with debt and deficits driving interest rates higher, I think that fear might be a bit misplaced. Over long periods of time, certainly, but in an environment where you're struggling to sustain growth, I think it's important to use all the tools at your disposal. The Fed was doing as such, and I think it's important for fiscal policymakers to do it as well in that type of environment.
Well, I was referring to the U.S. market, so we're at 5% unemployment rate. We're close to full employment,
Sure.
and if we should cut taxes, it could have certainly a short-term effect on interest rates.
So if we were to cut taxes, a short-term effect in terms of increasing interest rates? So again, you could see that, but I just don't see that playing out in the near term with conditions where they are. The U.S. remains a safe haven currency. I don't know that and I'm not advocating for or against tax cuts by any means, but some of the proposals floating around out there by candidates would certainly increase debt to GDP. That would not be an appropriate long-term policy. But I don't know that just because you saw changes to the tax system that you have to see an increase in interest rates.
If the 60-40 forward returns are lower than average, as advisors, what should we do?
I think you just have to be, and we are as well, we're just frank, open, and honest, and upfront with our clients. We acknowledge the environment that we're in. We make sure that our clients understand that the next time you hear about oil prices falling, you might not want to pick up the phone and think about making a decision. Okay, it's a volatile environment. Longer term, you're actually making out reasonably well, particularly from a real return standpoint. You may not be able to achieve the 6, 7, 8, 9% returns that you might desire. If you're able to change your spending habits, maybe you may need to think about doing so. If you're able to change your savings habits, maybe you may need to think about doing so. If you have to move yourself out, if you're glued to that 6, 7, 8, 9% return, maybe you have to think about reevaluating your risk tolerance and moving out the risk-return spectrum somewhat. I think it's important just to be open and honest so that they can make those educated decisions in the current financial market environment. Sure.
I noticed that one of your pages had a section on commodities, and I'm wondering if you view commodities as a good investment at this point, you know, that are cheap and have potential for high returns. Especially oil, of course, the main dominant commodity.
So, forecasting commodity prices, particularly oil, has created many orphans. So we certainly do treat that with a great deal of respect, because we had a lot of conversations during the GFC when oil prices were very volatile. So investors would say, well, I see oil prices are up 110%. Why is my portfolio of oil or commodities only up 20%? Well, the idea is that in order to get that, you're not buying barrels of oil, right? You're buying futures. So if the whole futures market believes that oil prices are going to rise 110%, it's very, very difficult for you to turn a profit. Okay? So to say commodities would be an attractive asset class, I wouldn't have done the work to be able to do so. I'd have to dig into it quite a bit more, and I think that investors who are thinking about an allocation of commodities need to fully understand, one, the commodities that you want exposure to, two, why you want that exposure, what you're doing with that. Are you looking to hedge your portfolio against inflation risk? Are you looking just to have exposure to commodity returns? That's another part of the discussion. And three, how you're getting it.
You guys have a big beauty portfolio. This is a lot of our clients. If we get 5% returns for the next 10 years, what happens to all the pensions?
So, in terms of the pensions that are still targeting 7% returns,
Yeah.
they're going to face some difficulties. I know, for lack of a better term, it really is, unfortunately, a harsh reality. I know a lot of the state funds and whatnot have lowered their target. So in lowering your target, you're just acknowledging the idea that you're not going to hit these potential return targets, so you have to make more of a contribution. So unfortunately, it's a situation where some of these states, some of these other pensions may have to start making larger contributions. The flip side of that is the economy is on a bit surer footing. So if you're a state fund or a local city, your tax revenues are likely a little bit higher. Okay, so that might put you a little bit more allow you a little more of an ability to make those types of contributions. Same goes for industries. If you're in an industry that's benefited from the quote-unquote strength in the U.S. economy, you might be in a better position to make additional contributions in the current environment.
A lot of the advisory clients as well as their clients are asking about interest rates in general, where they're going. Could you spend 2 minutes on the slide that shows our projections for Fed policy over the next 2 to 3 years?
Absolutely. So this is one of my favorite slides in the deck. So what we show here, the dark purple line, or the dark purple squares rather, that's the median Fed funds dot. Okay, what's the Fed funds dot? So Fed meets 8 times a year. Right, 4 times a year they hold a press conference, and along with that press conference, they actually release their summary of economic projections. And within those projections, they have dots from each one of the members on their estimate of where the appropriate federal funds rate would be at the end of the year. Okay? So this represents the median of each one of those dots. You can see 2015, miraculously they hit it, because this was released in December, and they raised rates to 25 to 50 basis points. Okay? Going forward, their dots tend to be a little bit higher than ours. Okay, they tend to be, it seems from this vantage point, they're a little bit more hawkish, where our views are in that red line there. Okay? Our expectation is for the Fed over the next 12 months, maybe to get to 100 basis points. Okay? At 100 basis points, in all likelihood, they'll pause for some time. Okay? John Williams in San Francisco has talked about this, San Francisco Fed. He talked about the idea of getting to a certain level and then pausing to assess the impacts of monetary policy on the economy. Because monetary policy acts with a lag. Okay? So let's say they get to around 100 basis points by the end of the year. They pause for around a year. At that point, they assess the situation in terms of their balance sheet. Maybe they start allowing their balance sheet to roll off over the course of the next several years. But again, get to around 100 basis points, pause, assess the situation. Then going forward, out into 2017, our crystal ball gets even foggier. Okay? Probabilities of recession, again, we're having constant discussions around that. You see probabilities anywhere from around 5% to 30%, based on if you're looking at markets, you're looking at certain prognosticators, what have you. Ours somewhere around 10 to 15, right, in the current environment over the next year or two. Out into 2017 and beyond, that starts getting higher. Okay? That starts approaching 20 and beyond. Right? So what we did for our exercise to see and sort of cue in on where we are relative to Fed policy, where we are relative to the markets, was that dotted blue line represents Fed policy if there were to be a recession. Okay? If we were to go back into recession, we're going back down to the zero lower bound. Okay? We're going back down to the zero lower bound. Maybe we're implementing quantitative easing. Again, nothing is off the table. If we were to continue along that path out through 2017 and beyond and not run into recessionary conditions, okay, we believe that the Fed will head to a terminal rate, which is the long-term neutral Fed funds rate, the rate where there's full employment, inflation is at its target of around 2%. We believe that rate to be around 3%. Okay? In the past, that had been 4.5%, 5%. Right? We don't think we're going back to that. Right? We don't think the Fed is going to raise rates to 5, 5.25% like they did following the 2001 recession. Okay? We think they're going to stop at a much lower terminal rate. One of the biggest reasons for that is our outlook on growth. Okay? We're not going back to 4.5%, 5% growth. We're going likely to 2% trend going forward. So our views on the terminal rate are much lower. Right? So what we've done with the rest of the red line there in between the dotted blue lines is we've looked at it, again, the probabilistic framework. We've applied a 20% probability of recession and then an 80% probability of avoiding recession. So you multiply those out, add the top and the bottom lines, and that's where you get that dotted red line, or the solid red line rather. That actually mimics rather well what the forward curve in the market looks like today. Okay? Forward curve in the market also expects that the Fed dots are going to continue to come down. We've been very vocal about that for some time. The Fed dots actually started 2015, at least the terminal rate, at around 4.25%. They've since come down in subsequent meetings to around 3.5%, and we think that it's going to come down even more than that, down to somewhere around 2.75, somewhere in that range over the course of time. What does all this mean for interest rates? Okay, so this is the path, our views on the path of policy rates going forward. Everybody talks about interest rate increases, right? Well, what interest rates? We're talking about credits, we're talking about the 10-year treasury, talking about policy rates. So this is our view of the policy rate, okay? For 10-year treasuries, what you would do is just aggregate those over time. Okay, you aggregate the sum of your views on 3-month treasuries over a period of time, sum those up, such that 10-year treasury, fair value, according to our calculations, somewhere around 2.25%, 2.25%, maybe 2.5% at the high end, higher than it is today. Again, I mentioned before it was somewhere around 1.8 last time I checked. But those individuals that are fearing a 100 basis point correction in interest rates, those fears may be misplaced. Okay, we saw what happened after Ben Bernanke mentioned the idea of possibly thinking about considering tapering at some point in the future back in May of 2013. That was enough to send interest rates across the board up 100 basis points. That's not our base case. Okay? Our base case is for a slow, gradual return to policy normalization, and in all likelihood, you're going to see a bear flattening wherein longer-term interest rates, 10 years and beyond, stay relatively well anchored, provided inflation expectations are maintained at reasonable levels, and you start to see an increase at the shorter end of the curve. So much of that increase comes at the shorter end. So it's those individuals who may have moved into shorter duration portfolios, fearing an interest rate increase, may have moved right into the teeth of those types of maturities that may be most impacted by Fed policy.
The Fed's growth outlook has consistently been too high every year for several years now. They keep bringing that down. Is there something wrong with their model?
I don't know that there's anything, well, there's something wrong with every model. I don't know that there's anything inherently wrong in their model. I think a lot of people followed a similar model because a lot of people were providing expectations of growth of 3% or north of that here in the U.S. The Fed actually has come down somewhat. So too is the IMF, so too of other investment providers. We've actually come down a little bit more. And the reason for that is on the left-hand side. Our views on potential growth mimic those at the CBO. You can see that in the solid blue line there. Individuals have been waiting, like the Fed. Okay, Janet Yellen was a big proponent of the idea of a cyclical rebound. Okay, at some point, we're going to get that bounce off the bottom that we've been waiting for. You're going to have an influx of workers back into the economy. You'll see the unemployment rate increase. We don't think any of those things are bad. Okay? We think the cyclical rebound was actually growth somewhat above long-term potential for the last 3 to 5 years. Okay, those quote-unquote low numbers were actually somewhat higher than they should have been. Okay, the growth of 2, 2.25%, 2.5% that we'd experienced, that was higher than 2% that in all likelihood we're going to face going forward. So we think in the current environment, we're going to trend down towards that 2%. Okay, 2% is our estimation for the current year. It's our estimation going forward out the next 4 to 5 years. We just don't think potential is much higher than that given labor market dynamics, given underlying productivity numbers and such. And then also in terms of employment, I mentioned before the Fed thinks that there's going to be, they were waiting for that cyclical bounce in employment. We think they've moved away from that somewhat based on their acknowledgement that non-farm payrolls are going to start coming down, much like we do here on the right-hand side, where we show employment growth in the light tan line coming back down to labor force growth in the dark blue line. Such that, again, as I mentioned before at the outset, our view is for non-farm payrolls to approach 125, maybe 150,000 jobs a month sometime middle of this year.
In the outlook, you look pretty pessimistic on tips. What role do you see them playing in someone's fixed income portfolio?
So we have a lot of conversations about tips. We have a lot of conversations about whether tips are a good inflation hedge. Tips are a great inflation hedge for tips. So if you have a 5% allocation to tips in your portfolio, 5% of your portfolio is hedged against inflation. Okay, tips beta to inflation is around 1, so it's not going to give you an additional inflation protection. In terms of us being quote-unquote bearish on tips, I think that really comes to the idea that inflation is likely to lag expectations going forward. You're likely to see a much slower return to the Fed's 2% target, maybe than had been expected in the past, such that while there's not outright deflation, you might have been better off in that nominal bond earning that additional inflation risk premium that nominal bonds tend to earn over tips. That's the reason for our bearish outlook on tips. Any other questions about this asset class allocations?
Just real quick, any thoughts on the high yield space outside of the impact that oil has had on it? Any thoughts on high yield in general? And from like an asset management standpoint, you know, the advent of the unconstrained bond fund with people reaching for yield. Any thoughts in general on that?
So I think high yield, you've seen spreads not really blow out, but they've been widening. And some individuals are getting concerned, but at the end of the day, high yield bonds are high yield bonds. They tend to have volatility that's almost equity-like. So individuals who may have reached out the yield curve, again, we talked about the idea of low returns of fixed income portfolios. So those individuals who may have reached out the yield curve in hopes of offsetting some of their lower than normal returns in fixed income, maybe moving into assets that may not provide the same type of diversification benefit that investment grade bonds would. So what we show here is this is the median return of various asset classes in periods wherein equity returns witnessed the bottom decile of historic levels of returns. Over the last 26 years, bottom 10% of equity returns in these given months. And you can see over on the far right, treasury bonds, even investment grade corporate, even investment grade international, those tended to perform the best in those downturns in the equity market. Individuals who may have moved into even emerging market bonds, high yield bonds, they tend to be much more equity-like in their volatility, so they don't have as much diversification impact as your investment grade and safer securities would. So we caution investors, if you're moving into high yield, hoping to offset your low returns in your fixed income portfolio, realize you're increasing the volatility of your portfolio. Any other questions about this or anything else I've covered today?
I got one.
Sure.
When it comes to forecasting, Warren Buffett famously said there are those who don't know and there are those who don't know that they don't know. You guys have been doing this sort of thing for many years. You've got a lot of smart people working on it. What is your level of confidence when you look at these projections, generally speaking?
So I would say, it kind of hurts my pride a little bit to say I don't know. We're cognizant of the fact that it's difficult to know. So I'd put us in the camp of we don't know. We know what we don't know, right? We're aware of the risks inherent in forecasting. That's why we approach this from this probabilistic framework I've been explaining. That's why we provide both the upside and the downside risks to any sort of framework. You're not going to see Vanguard call 8.5% equity returns over the next 12 months. Okay? We'll talk about long-term time horizons. Right? We'll talk about 6 to 9% range, but then present it in a way that you can see that a 20% or more annualized return over the next 20 years, that's great. Not out of the realm of possibility, but not very likely. Right? So too would another lost decade, hopefully. Okay? We're not saying that you won't have another 2008, 2009 experience where all of your equity returns over the previous 10 years are wiped out. Okay? But that's not our base case. It's in the realm of possibility. We think these are the most important tools you can provide to investors to help them make the most appropriate asset allocation decisions for their particular situation. Any other questions? Thank you. I appreciate the time and your attention.